Good day. My name is Rick Shrier, founder and managing director of Shrier Associates, LLC. With over 4 decades in the financial services industry and a fiduciary to my clients since 1994, my goal is to help my clients reach their lifelong financial goals and aspirations. It is my desire today to introduce you to a method, at least in my opinion, to better manage your financial assets. Take a look at this slide for a second. It's a pretty good comic. I know it's supposed to be humor, but sadly, it's true. You hear me use the term a lot: industry inertia, fed to us, news, resources, technology, all consumed. Here is a recent real-world example that just took place. Many firms taking one position and another firm offering a complete opposite. The truth is, there is no crystal ball that's telling people what's going to happen in the markets. However, risk is manageable, so let's focus on that. Wall Street experts who get paid millions of dollars have more resources than anyone, continuously get the direction of the 10-year yield incorrect. Many people like to pontificate what the markets will do, but the truth is nobody knows, no matter how much money they invest. Let's focus on what's important, and that's drawdown risk. Many people like to look at historical 10-year returns to see how an investment will do moving forward. Is this really an accurate measure? The S&P 500 annualized over 18% from 1990 to 1999 based on this data. You'd think this is a great place to put your money, right? Well, let's take a look at how it did over the next 10 years. Less than 1%. And that's only if you held through not one, but two very large drawdown losses of over 40% and didn't change or move your investments at all. And let me tell you, not many people did stay consistent through this. Would you be okay seeing your portfolio fall from $1 million to less than $600,000? You wouldn't request your advisor to make any changes? But many people think of themselves as non-emotional and won't react when their portfolio does. But let's take a look at the real data. The Dalbar study. The dark blue shows two indices, the S&P 500, which represents the 500 largest companies in America, and the AGG, which represents the bond market. How they performed over the course of 20 years. The light blue shows what the average investor received on their investment. On average, they earned less than the actual index. Why? Because people don't buy and hold like everyone says. They get emotional, everybody after large losses, and to adjust or sell out. It's natural investor behavior, the basis of behavioral finance theory. Now, let's talk about why large losses are detrimental to retirees and pre-retirees. Traditional asset allocation was built for large institutions with infinite time horizons. They can hold through large losses. In fact, they just add more money when the market is down, potential lower priced opportunity, knowing that they can wait as long as needed to turn a profit. Individuals like us do not have infinite time horizons. We need to pull money out of our accounts. When you do that during large market loss, it can have a significant impact on our portfolio's ability to get back to even. Let's put some numbers to this statement. This slide is showing the implications of taking money out of your account during a market decline. Each set of columns represent different declines in a portfolio, and the green and yellow bars represent the gain required to get back to even. The yellow bar assumed you take 6% out over a 12-month period. The yellow bar shows just how much you need to get back to even. For example, with the third set of columns, if the market drops 20%, like it did in 2022, and you take this 6% withdrawal, you will need your portfolio to go up 35% just to get back to even. This is why managing risk is so important. The most important thing is this process. First, we need to know what to expect. With insurance, expectations are clearly defined. But with managed money, it's difficult to define what's going to happen because we can't predict what's going to happen. Step 2, implement an investment management plan that directly correlates to the expectations on a forward-looking basis. And step 3, I empower each of my clients with the content and knowledge to know that your plan is working from a personalized basis. My clients can expect timely and relevant content regarding your portfolio and not generic institutional portfolios. Difference between long only and tactical. Long only is always invested. It never moves to a safe haven like cash. Thus, it can experience large losses like the chart shows. This drawdown risk approach differs from labeling a portfolio conservative, moderate growth, etc., which doesn't mean anything. I mean a Morningstar conservative portfolio that advisors were using for retiree clients experienced a 34% drawdown in 2008. I build portfolios aimed to keep the portfolio within or above predefined drawdown losses. These portfolios are engineered, forward-looking to reach these objectives. This way, we can choose what level of targeted loss that is appropriate for your plan. Everyone is going to have a different loss threshold that they are comfortable with. ERB simply means engineered risk budget and the numbers of the targeted loss in a portfolio worst-case scenario. This is how we can measure success for our portfolios. Number 1, is the portfolio drawdown target? Is it within or above? Number 2, the 6-month range of returns. There is a 95% degree of confidence that your portfolio's rolling rate of return will be between minus 3.04 and plus 9.15 when you and I review in 6 months from now based on the ERB 8 to 12 portfolio. If both are accomplished, great, you're on track. Both these variables are calculated to a 95th degree of confidence. These portfolios are not just made of tactical funds. They combine tactical with strategic. Tactical means the ability to move in and out of the market for risk on and risk off, as I like to put it, meaning you're either invested in the associated asset classes or you're sitting in cash to avoid market volatility. Each style of investing, tactical and passive, has pros and cons. There's a long debate on Wall Street whether you should be in one or the other. But there's no reason to be binary, meaning we don't have to choose one or the other. Strategic only pros and cons. Pros, you stay invested to capture strong market rallies. The cons, however, during times of market crisis, these positions may incur large drawdowns. Tactical only pros and cons. The pros, it seek to avoid large drawdowns by moving into defensive positions. On the other hand, the cons are whipsaws, strong market rallies while being defensive. A blend of both, non-binary. We don't have to be one or the other. We can be some of each. Based off of step 1, we will be able to measure whether they are working or not. Keep in mind there is still a 5% probability we will end up outside of this range. It's important to know that this doesn't mean our plan isn't working, just means that we are experiencing one of those 5% times. More than just the ranges, this is the step where I will be able to provide all relevant communications about your portfolio and your experience. Now let's take a look at some experiences. This actually happened. During COVID, March 2020, In our most aggressive model, we were able to minimize losses over our benchmark, the long-only 80/20, by 6%. Doesn't seem like a big number, right? And on the upside, we captured just 1/3 of the upside, 4% instead of 12. Now, which of the two portfolios do you think ended up higher in terms of account value? Well, let's take a look. Our portfolio. We had our analysts run these numbers multiple times because the math seems to not line up, but it does. We win by not losing. Something we call it exposure management, exposure to risky assets during good times, and non-exposure to risky assets during bad times. Now, in conclusion, I do not know what the market will do. No one does. I have a quantitative process to manage risk in order to help my clients pursue their goals that I think is the highest probable solution. Thank you very much for your time today. Please feel free to reach out to me at 508-898-9500 or at rick@shrierassociates.com with any questions or concerns. Have a great day.